Greetings, everyone. I'm David Darst, here to give you a short recap of the month of May 2023. The Standard & Poor's 500 was up 0.2%, so a very small gain. After April was up 1.5%, March was up 3.5%, and January was the big month this year, up 6%. So when you get finished with all of this, S&P up 8.9%. The big winner so far this year, and we'll get into this in a moment, has been NASDAQ. The NASDAQ Composite Index is up 23.6%. A couple of big months. January was a big month, up 10.7%. March was a big month, up 6.7%. And May, up 5.8%. By the time you get done with this, the NASDAQ Composite Index is up 23.6%. But the NASDAQ 100, which is even more concentrated, can you believe this? As of the end of May, it's up 30.3%. Then by contrast, we turn to the Russell 2000. Now, this is your small and mid-cap companies, which, as you know, they account for a lot of the employment, they account for a lot of the economy, and they are really the core, the essence, the center of the United States economy. And so far, through the month of May, it's down 0.7%. Turning to gold and oil. Gold right now is up 7.9% as of the end of May. The month of January up 6%, and the month of March up 7%. It's given ground in the other 3 months, but so far gold at $1963.90 per troy ounce as of the end of May is up 7.9% for the year. Then we turn to oil. We have this OPEC meeting taking place early June. The demand side of oil has not been as strong, and the supply side has been maybe a little bit more abundant than people had been forecasting or expecting. Oil was down 11%. That's the worst month thus far this year. And thus far this year, oil is down 15% to West Texas Intermediate is trading at $68.19 per barrel. So there you have it for the stock market and for the gold and for oil. Now, turning to bonds, the two-year Treasury closed the month of May at 4.40%. It was up 36 basis points in May, but for the year as a whole, compared to the end of last year, 436 to 440, it's up 4 basis points for the year to date. It's been up, it's been down, but it's basically not that much changed. And similarly for the 10-year, the 10-year closed at 364. It was 388 to begin the year, and you see the inversion. We've talked a lot about the yield curve inversion between the 2-year and 10-year. At the end of the year, it was negative 48, negative 50 basis points. It's gotten even more deeply inverted. That means people are wondering about the tightness of monetary policy continuing. At the same time, if that induces or exacerbates or exaggerates the recession, that would mean people would be buying intermediate term bonds, driving down their yields. So here's the short term, here's the long term. That's the way it's supposed to be. Short term's been high, long term's, intermediate and long term has been low. So the inversion has actually gotten deeper. It went from minus 48 to about minus 76. Now these are the 5 or 6 topics quickly that I want to run down. The equity market, I talked a moment ago, 5 stocks account for about 85% of the total 8.9% gain. But Apple alone is 26% of the stock market's gain. Microsoft is 23%. NVIDIA, which has come on very strong with this whole artificial intelligence, NVIDIA is 14% of the S&P 500's gain thus far this year. Google, which has come on very strongly recently, embracing this, 11%. And the last one, Meta, is 10% of the S&P's gain thus far this year. So you see this immense concentration. Those 5 stocks represent 82% of the S&P 500's total gain this year. So concentration and valuation for these stocks is quite high. For the other 95 stocks, it's not cheap, but it's much lower. Now, second topic, inflation. The Fed's looking at the core personal consumption expenditures inflation rate. Now, you saw that just came in for the month of April. It was up 0.4% for the month, up 4.7% year over year. The previous month for March was up 0.3% for the month and 4.6% year over year. So as far as the Fed's concerned is going in the wrong direction. It's actually going up for the main inflation indicator that they look at. You have producer price indexes there, that's slowing down considerably. Then we get to inflation expectations. You have the New York Fed and the University of Michigan Consumer Sentiment Survey analyze this. And just to take 1 year inflation expectations for the month of May, 4.2%, and April, 4.6%. So that's good. The Fed could say, okay, inflation expectations, they're still high, but they're coming down. However, on the 5 to 10 year inflation expectations, and this is your University of Michigan Consumer Sentiment, it's actually gone up from 3% in the month of April to 3.1% in the month of May. So inflation expectations moving in the wrong direction. That's point number 3. Point number 4, inflation influences. And there the Fed's looking at core services. That's still high. Core services. You have demand, and this connects to the labor costs. You have demand for labor in construction. You have demand for labor in hospitality and in healthcare. And that's continuing to put upward pressure on the employment cost index. We will get another reading, and that number comes out quarterly at the end of this month, at the end of June. They also look at rental costs and owner's equivalent rent, and that is expected to keep going down. So our view is that inflation numbers, as we look forward through the remainder of this year, you're going to see them going down, trending down. But as far as the Fed's concerned, maybe they're not going down fast enough. That brings us to point number 5, which is the Federal Open Market Committee meeting to set monetary policy. They will have a meeting on June 13th, 14th. It's a 2-day meeting. They have the employment numbers, which came in early June, as you may know. Early June, which was Friday, June 2nd, they came in much stronger than people were expecting. They'll have that. They will have the consumer price index will be released the morning of June 13th. That's the first day of the 2-day meeting. And the producer price index will be the morning of June 14th, the second day. So it's unclear to me whether the Fed will be able to incorporate this totally into their thinking and their deliberations. You know, you've been seeing this. It's been somewhat mixed, and it's gone back and forth. One day, it's 60% chance of no increase at the June meeting. No 25 basis point increase. No. The next day, it's 60% chance of a 25 basis point increase. I think you're going to have a lot of lively discussion at the June 13th, 14th meeting. Right now, I am of the opinion that it's going to be a very, very close call, a very close call. And let me just look forward. You have, after the June 13th, June 14th meeting, the next meeting after that is July 25th, 26th, also a 2-day meeting, Tuesday, Wednesday. And after that, no meeting in the month of August. You know this. You have September 19th, September 20th. And in my opinion, right now, you very well see the Fed perhaps cutting interest rates for the first time in September 19th, September 20th. The last topic is corporate profits. And on corporate profits, the second quarter, as you know, have already been reported, minus 2.1% year over year. That's the first quarter, minus 2.1% year over year. The second quarter is expected to be, and we're not finished yet, about minus 6.3% year over year. Third quarter is expected to be plus 1% year over year. And the fourth quarter is expected to be up 8% year over year. So by the time you get done with this, last year for the full year was plus 4.1%. This year for the full year, it's estimated to be plus only 1%. I do not necessarily agree with these analyst forecasts, and I think we're going to, as we get into the second half, and this is our thinking right now, as we have the rest of this year roll on, we think we're going to experience a reasonably mild recession, but nevertheless a recession. With that, we want to stress the importance of alternatives. We've talked a lot about liquid markets today. We want to stress the importance of alternatives. This is private equity. This is private real estate. And it's, of course, private credit, especially structured credit. With that, we wish everyone a great start to the month of June, and we look forward to catching up with you very shortly.